Hello friends, welcome to Adda 24/7. We are in the Shikhar series for BFM Module-A. Now it's Module B actually. This should be made as Module B. Okay, so Module B now because we have started risk regulations. So we are in Module B now. Importantly remember. Now the topic for today is risk regulations in banking industry. Basically in Shikhar series we are covering all the subjects, all ABM, BFM, ABFM, BRBL. In each subject we are covering the theory as well as the objective questions as well as the numericals, all of them. Today I'll be covering risk regulations, biggest chapter in your BFM, biggest. Check your book. Everyone go to your book and check it. It is the biggest chapter. Okay. What is there basically in this? Risk regulations. Regulation means what is the discipline? Who gives the discipline? Mainly it is from RBI and Basel. Okay, RBI and Basel are the two important bodies. Okay, who give all these regulations. Got it? So everyone like the channel, like the video also. Like the video right now. Okay, subscribe to this channel. Click on the bell icon. Okay, share it with your friends. So let's start. What is the role of risk regulation? Why should regulations be there in banking? Why do you need regulations in your life also? We all teach our children are all near and dear word there should be discipline. Why do we need discipline? For safety, for living better life. Same thing is over here for organizations also. Improving safety of the banking industry. Safety. Banks should be safe. Why banks should be safe? Why is it required that a bank should be safe? Why is the reason why the bank should be safe as such? The reason is, what is a bank? Bank is we are working as a trustee. So it's a trust of other people, depositors' money, which we are trusting, right? So improving the safety of the banking industry is of utmost importance. When depositor keeps money with you, the depositor expects that his money should be safe. He must get the principal and some interest. Principal is very important. If the principal is lost, then the depositor, in fact, the whole life of the depositor gets into shackles, isn't it? So safety of banking industry is of utmost importance. Leveling the competitive playing field of the banks. Leveling the competitive playing fields. What do you mean by this competitive playing field? Suppose if we don't have regulations, tomorrow if we don't have regulations, what will happen? Some bank will give loan at let's say 6%, some bank will give it at 4%, some bank will give it at 14%, depending on case to case and bank to bank. So they'll have their separate activities. Some bank will ask for this document, some bank will not ask for this document. Without financial statements, banks are giving loans, right? So NBFCs we see now, many NBFCs you just check on the auto or the advertisement. Get home loan without ITR and financial documents, without anything. So for that we need regulations. In banking we don't have this. In banking do you have it? That get the loan without ITR. Only KCC we have it, Kisan Credit Card, right? Remaining others we don't have it. Leveling the competitive field. Okay, so all should be on the same page. Promoting sound business and supervisory practices. Sound business means strong business fundamentals. What do you mean by strong business fundamentals? It means that suppose if tomorrow you don't have, let's say, capital, tier 1 capital, tier 2 capital, then what will happen? If there is any shock, like the shock had come in 2020 COVID, 2008, even now, suppose if some shock comes, Russia starts a huge war tomorrow. or Israel starts a war tomorrow, then the oil prices will definitely be affected. Not only oil, many others. So sound business means you must have that much capital so that in case of any shock, you should be able to bear that shock without closing your bank. Bankruptcy, that's called as. Understand, there are two capitals mainly. There are three capitals, but mainly there are two, tier 1, tier 2. Tier 1 capital is for absorbing these shocks without going into bankruptcy. Tier 2 capital is used when the company goes into bankruptcy and the money is paid off. At that time, tier 2 is paid off. In case of bankruptcy. Otherwise, regularly also you pay it. It's not that only in bankruptcy. Suppose if I issue some bonds and I'm in a sound position, I can definitely pay this tier 2 capital. Okay. But worst situation I'm talking, worst. So promoting the sound business and supervisory practice. Supervisory practices over here means RBI and auditor. RBI should be very focused. Okay, supervisory practices. Promoting sound business and supervisory practices. Controlling and monitoring systemic risk. What is systemic risk? I'll explain you. We are having a separate slide today on systemic risk. Very important risk. Okay. One bank fail, all the system fails. Protecting the interest of the depositors as depositors. Interest of the depositors. What do you mean by interest of the depositors? Interest of the depositors as depositors. So protecting the interest means what? Depositor, whenever he keeps the money with you, he keeps it with trust. So that trust you'll have to maintain. Depositor, it shouldn't happen that depositor feels I have wasted my money. I put my money in the wrong hands. It shouldn't happen this. Okay. So these are the goals. What is systemic risk? Systemic risk is the risk of failure of the whole banking system. Whole banking system. Now look at this. System doesn't mean IT. Many of you will feel that system means IT. System. We say na system failure system. This system is different. It is entire banking system. The bond structure fails. So systemic risk is a risk of failure of the entire whole banking system because of one bank. An individual bank's failure is one of the major source of the systemic risk. Individual, one bank failure. 2008, Lehman Brothers collapsed. The whole banking system collapsed. 2008. Same thing happened in 2022 also. Which bank? There was a bank. There was a failure again. Credit Suisse. Credit Suisse failure again. It was going to lead it to entire banking system failure, but it didn't happen because the people had learned at that time. So an individual bank's failure is one of the major source of systemic risk. Why do all the banks fail when one bank fails? See here, it's like this. It's a bond debenture relationship. Means what? When one bank, suppose let's say this is bank A. This is bank A. This bank A has issued debentures. Issued debentures, okay? To let's say all the banks, B, C and D, B, C, D and so on. It will go on and on and on, okay? So it has issued debentures, issued debentures, okay? So these debentures, what it has issued to B, C, D, if bank A fails, this bank fails tomorrow, then what happens? If bank A fails, then the debenture issued by bank A also fails, it becomes zero. This becomes zero. So all these banks will be facing a problem in the balance sheet because their assets will become zero. So this is the whole logic. The whole game is of debentures which are issued. Okay. So individual banks failure is one of the major source of systemic risk. This happens because higher interrelationships that exist on an ongoing basis between the banks through mutual funds or mutual lending and borrowing and other commitments, right? So it means between banks through mutual lending and borrowing and other commitments. So this bank will issue bond, this bank will give money, B will give money to A will issue the bonds. If the bonds fail, then this money is lost. Also, there is investment in terms of, let's say, call money. In call money also, many of the banks invest, cooperative banks generally, invest with some private banks for call, everyday call, through that system of what NDS call, right? NDS call is a system now. So they invested through NDS call to various banks, through various private banks. Tomorrow if this bank fails, the whole money is lost. Okay? So this is basically the interbanking here, ongoing basis between banks through mutual lending and borrowing and other commitments. Okay? Receivables from the failed bank become non-available, putting the counterparty bank in cash or funds crunch. Right? So A has issued the bond, B has taken these bonds. Now A says I don't have money. When A issued the bond, A took money. It's like the FD relationship, right? Bank will issue the bond, bank will issue the FD, customer will take that FD and give money to the bank. Then bank will say I don't have money to pay your FD now. The same logic, no change in this. So this is systemic risk. Okay, failure of one entire banking system due to the failure of one bank. Then we see these Basel III norms. Basel III norms have three pillars. Okay, one is minimum capital requirement and liquidity requirements. Second is minimum capital requirement and liquidity requirements. Pillar 2 is supervisory review, SREP we call it, supervisory review. Okay, so supervisory review. And third one is market discipline. Market discipline means disclosure. Now what is there in each one? See here, we are having a separate chapter, a separate topic on Basel later. I'll just give you the hint right now. Today we won't be going into the details. Minimum capital requirement. So here it comes. Excuse me. Here it comes. The three risks. Okay. All the three risks are over here. Which one? Market risk. Then ops risk, and third one is credit risk. All the three risks are over here. Credit. Okay. So ways to calculate it, these are also here. All the three various ways. Generally there is a basic method, standardized method and advanced method for all these three. Generally, slight variations are there. So market, ops and credit risk. These are the three main risks covered over here. Then you have CRAR over here. CRAR is from Basel. Okay, Basel III norms. Capital to risk weighted asset ratio. So this ratio is studied over here. Then you have four ratios of Basel which come into picture over here. One is your NSFR, net stable funding ratio. Then you have LCR, liquidity coverage ratio. Then you have leverage ratio, leverage. And fourth one is this CRAR. So total four ratios you see over here in pillar 1. Okay. So market, ops and credit. These are the three main risks and the methods to calculate it. See this, not only these risks, you have methods to calculate it. Methods, what are the various methods? Okay. Like for example, I'll give you for credit risk. Okay. Credit risk, you have your standardized method and then FIRB, AIRB. These two methods are there. Means standardized and then IRB method. Shall I write it? Say this. Credit risk, you have standardized method, standardized. Okay, I'll write it over here only. Okay. Credit risk, you have standardized, standardized and IRB. Standard and IRB. IRB means what? This internal rating based. So this IRB again has two parts. Okay, FIRB foundation, FIRB and AIRB. So these are the methods for credit risk. Okay, for ops risk, ops risk, there are various methods. Basic indicator approach, BIA we call it, BIA. Then you have standardized approach, standardized or standard, I'll write it, standard. Okay, and third one is AMA, advanced measurement approach, AMA. So these are the methods for ops. And market is difficult. Market I won't write it because there are many methods. One is here. Basically there are two only, back testing and stress testing. These are the two basics for market. Okay, I'll write it over here. Market you have back testing, stress testing. In that you have many things, back and stress. In that you have many things. Okay, many other sub methods are there. Okay, means sub methods means there are many as such. For in the sense you have this this VAR method, value at risk, that is also used in this both back and stress. Okay, plus many others are there. So it goes on and on and on. So pillar 1 is basically market, various types of risks, methods of calculating it, various ratios. Okay, remember these important ratios are there: CRAR, NSFR, LCR and leverage ratio. Okay, what I mean by this, I can explain you this in hardly 2-3 minutes. Say this. CRAR, okay, let me remove all these things. Now you have got this, let me remove these. So now CRAR, okay, capital to risk weighted asset ratio. Okay, so that is equal to your capital upon this, capital upon your RWS. Capital is of two types, tier 1, tier 2. Capital is of two types, tier 1 and tier 2. Okay, RWA are of three types, risk weighted asset. They are of three types, credit, market and ops. Okay, these are the three types of RWAs. Based on this you calculate this CRAR. Then second ratio which you have is, this is your NSFR, net stable funding ratio. So required stable funding, here I teach this on a regular basis, that's why I remember this. I know it's very difficult. Required stable funding, okay, upon available stable funding, okay. So this is basically NSFR. Okay, the important part over here is what is required stable funding. Whenever I say required stable funding, it means what I mean by this, it means how many of the government bonds. Here firstly remember, NSFR is for long term, NSFR is for long term, not for short term. Here you require how many stable government bonds you have, government bonds, sovereign bonds, government bonds you have, whatever is required versus whatever is available. Not only government bonds, here stable funding can be of through various sources. One is through government bonds, means they'll give you a regular interest. Second is your CASA. CASA is also a source of your stable funding. Generally it is seen that, it depends on bank to bank, but generally it is seen that 55% of the CASA generally remains in the bank on a regular basis. But I don't guarantee this for each and every bank, because what happens is, it depends on bank to bank. Some banks CASA might be very fluctuating. Out of, if you have 100 rupees CASA, then people might be, customers might be withdrawing, let's say 80 rupees out of this on a regular basis. In some bank the CASA might be such that customers are withdrawing only 30 rupees out of 100 rupees. Remaining 70 are constantly remaining with you. When they constantly remain with you, they become the FD component of the CASA. So that is considered as stable funding. Okay, so CASA is one stable funding. government bonds, FDs. FDs are also a stable funding because once a FD is booked, generally it is not broken. FD. So these are all stable funding. So the question over here is required versus available. How much CASA you have, how much CASA is required. How many government bonds you have, how many government bonds you require. How many FDs you require, how many FDs you have. So that is basically NSFR. Kindly remember it is long term, generally for 1 year. Okay. Then you have LCR. LCR is simple. LCR is for short period, short, 30 days. 30 days. Okay. What is LCR? LCR is very clear and simple. Liquidity coverage ratio. Okay. Liquidity. See, liquidity means what? Why 30 days is used over here? 30 days is used because whenever there is something called as run on the bank. Run. What is run on the bank? Run on bank. What do you mean by this? Whenever any bank's bad news comes out, any bank, you check it in your bank also, any bank, bad news out, all the people come there for withdrawal of deposit. Withdraw deposit. Withdraw. Huge rush in the branch, right? Withdraw deposit. I don't know from where do they come. Okay. But here, kindly note your nationalized banks are having the government backing, right? So that's why people need not worry. But then also, there's a run on the bank. To cover this run on the bank, you should have HQLA, high quality liquid assets. HQLA. Okay. HQLA, high quality liquid assets, means what? These are government securities, generally T-bills. T-bills, short-term T-bills, which can be immediately sold in the markets. Here, HQLA means what? The one which has secondary market available. Secondary market means what? If I have some share of Reliance, let's say today, and I want to sell it, so immediately it gets sold, isn't it? It will get sold immediately. Why? Because it is having liquidity. So HQLA means high quality liquid assets. It means it should have secondary market available. So that is LCR. LCR means that is basically liquidity coverage ratio. Okay. So important part which you have to note over here is this secondary market. If secondary market is not available, then it can't be considered as HQLA. Okay. Got this point? So what is the formula for this HQLA? Okay, what is the formula for this HQLA? See, this formula is very simple. Formula means your HQLA, amount of HQLA you are having, HQLA upon your cash outgo. What did I say? Cash outgo for 30 days. 30 days. Why 30 days? Because what happens whenever there is a run on the bank, okay, then for initial 30 days there's a huge panic in the market. All of them go there, but within after 10, 15, 20 days, somebody else takes over the bank, purchases that bank. Okay, like the same case in Yes Bank. In 2017, Yes Bank had a problem, so SBI invested in it. Similarly, one LIC had invested once in IDBI Bank, right? So the things are like this. So HQLA upon cash outgo for 30 days. Okay, so that is about LCR. Next you have is this leverage ratio. Leverage. Okay, leverage ratio. Leverage means what? What do you mean by this word leverage? Leverage ratio. This ratio, because here this is important. These are the important terms in your risk regulation chapter. Okay, so leverage ratio. Leverage is what? What is the capital you have versus what is the loan you are giving. It's that simple, isn't it? Correct. So what is the capital you have versus what is the loan you are giving. So how do you measure leverage ratio? See here, I'll just write it in simple terms. Capital upon, I will call it loan. So loan means you can call it exposure. Exposure means loan only. What is the difference between exposure and loan? Exposure and loan, what is the difference? See here, exposure equals to loan amount plus haircut haircut is applied over here. That's called as exposure. If some loan is having 20% haircut, it means that I give a loan of 100 rupees. See, if the loan is of 100 rupees, 100, and haircut is applicable for 20%, 20% haircut. So my exposure will be, okay, will be 120 rupees, 100 plus this 20%. So 120 rupees will be my exposure. So understand the difference between loan and exposure. Okay. So now what is the formula? The formula is, see this, capital upon exposure. Generally it is taken as T1 capital. Tier 1 capital. So tier 1 capital upon exposure. Okay. Why tier 1 only? Why not tier 2? What did I say about tier 1 earlier? Tier 1 is known as going concern. See this T1. T1 is known as going concern. Going means it's my own money. Going concern. T2 is known as gone concern. Gone. When the bank is gone, then you'll get the money. Okay? When the bank is gone, then you'll get the money. That's why the basic definition of T1 and T2 is what? It can absorb the shocks without going into bankruptcy. And T2 is what? It can absorb the shocks when the bank goes into bankruptcy. T2 is taken always at the end. That's why the percentage of T2 is very less. Look at this. T2 is always 2%. T1 is always 7%. 7. Okay. So 7 plus 2 is 9 CRAR. Do you know the basics of CRAR? See this. CRAR is like this. 7% for T1, 2% for T2, then total is 9%. From here, now RBI has made it compulsory that all of them should have CCB, capital conservation buffer, that is 2.5%. So your CRAR becomes 11.5%. Okay, so RBI has made it compulsory that it should be 11.5% minimum. After that, if in extreme situations, extreme means like in COVID, okay, extreme situations, RBI put CCCB, counter cyclical capital conservation buffer, that is again 2.5. This is regular, see this is regular and this is in extreme. So 11.5 you have to keep it at any cost. But if the extreme situation liquidity is very high, in that case RBI will put on this and it becomes what? 11 plus 2, 13, 14%. So your CRAR becomes 14%. Okay. Do you know during that Notebandi time, Notebandi we had na 2016. Do you know what was the CRAR at that time? During the Notebandi time, what was the CRAR? During the Notebandi time, the CRAR was, means that November to January, I think so, isn't it? November 2016, 8th November 2016, right? CRAR was 104%. 100% was for all the notes which were deposited. 500 and 1000 were there, na? 500 and 1000. So all the notes which were deposited, this was 100%, and remaining normal banking was 4% at that time. Normal banking. So it was like this only, normal banking. Normal CRAR was there. So 100 plus 4. Okay. Now you see, that time everyone kindly understand, during in 2016 when the first Notebandi was done, there was so much panic. In fact, panic was not there, it was created by the media and some rogue elements. There was no panic as such. So in that case what happened? 100% it was there. But look at this second Notebandi which was done. People didn't even come to know that Notebandi has happened. Do you know? When was the second Notebandi done? People didn't even come to know. When was it? Just type in the comment section which note was removed in second Notebandi. Which note was removed in second Notebandi? Who can tell me? There was done. Let me see in the comment section. Which note was removed in the second Notebandi? It was 2000 rupees note. Okay, 2000 rupees note was removed. And people didn't even come to know that 2000 rupees note has been removed. Okay. So second notebandi was done very silently, without giving any shock to the common people. Right? So this was about Basel 3, this pillar 1. Okay. Pillar 2 is SREP, supervisory review process. That I'll discuss it later. SREP and market discipline. When we'll cover that topic, we'll be covering this. So today's topic is only regarding risk regulations. So now let's see what are the 5 C's of market credit risk. See, credit risk has 5 C's. What are the 5 C's? This you have studied it in your ABM also. Character. Character means what? Here we mean financial character, not the personal character. Of course, personal character is important, but main important to us is financial character. Financial character of that person. How do you get this financial character? You get this financial character using civil and others, basically all. Okay. Then you have collateral. What is the collateral you are taking? Right? Collateral is also important. Collateral, this. Okay. Then you have this capital. Capital means what is the capital this person is having. Okay. Then you have conditions, economic conditions. Okay, conditions. Then you have capacity, whether the person has a capacity. Okay. So it's done in this sequence. See, this character, financial character, then the capacity, then the collateral, then the economic conditions, and then the capital. This is how it is checked. Okay, so these are the 5 C's of credit risk. Okay, character, capacity, collateral, conditions, and capital. Okay. These are the various risks in banking. Look at the various risks. Let me expand this. See this. This already I have discussed in my earlier lecture. Risk in banking business. Credit, market, liquidity, operational, concentration. Concentration is something new. Concentration means giving all the loans to a single sector. Like steel. I'll give all the loans to steel sector. So that is risky. You should not do this. You should never give all the loans to a single sector. That is a riskier part. Okay. So concentration risk. The next one is what? Other risk. Country risk, settlement risk, legal risk. See this, country risk. This I have discussed. This is a part of your credit risk only. Settlement risk. This is a part of your credit risk only. A sort of. Okay. Legal risk. This is a part of your operations risk. Legal risk. Okay. So operational risk over here. Settlement is generally known as Herstat risk. Herstat. It's a part of your settlement credit risk. Market risk is very difficult. Market risk is of 4 types. Not only 4, there can be many. Foreign exchange, interest rate, commodity, and equity. There can be many. Kindly check this. I have discussed this in the first lecture. Risks in banking business. Okay. Got it, everyone? Now let's move on to the questions. Under RAROC framework, which of the following statements are correct? So which one is correct under RAROC? Now you have to find out. You have to give me the answer. Which one is correct under the RAROC framework? Lender begins by charging. Lender begins by charging an interest markup to cover the expected loss. Lender allocates enough capital to the prospective loan. Provisions plus allocated capital reserves covers only 40% of the loan loss outcomes. Which is true over here? Lender begins by charging an interest markup to cover the expected loss. Is it so? Interest markup. Markup means what? Whatever is the risk that is covered by extra interest taken from that customer. So A will be definitely true. Right? Interest markup. Lender allocates enough capital to the prospectus. Here we want which one is correct. Okay, it can be either of these. A is true. Now let's look at B. Lender allocates enough capital to the prospective loan. So enough capital should be allocated. Obviously, if you don't have enough capital, then the loan will, this LCR will be a problem and NSFR will be the problem. So therefore enough capital is provided for that loan. Okay, your leverage ratio will be affected. See, what is leverage ratio? What is the loan you are giving versus what is the capital you are having. So A and B are true. But what about C? Provisions plus allocated capital covers only 40% of the loan loss outcomes. Does it cover only 40%? Means 60% is with risk. Not possible. Okay. So the answer will be what? Let me see in the comment section. What is the answer? A and B. Okay. A and B is the answer. Got it? Next. Which of the following is incorrect? Now look at this. The question is reversed. You want incorrect. Which of the following is incorrect with respect to LRM? Loan review mechanism. LRM is basically the bank audit. Okay. Loan audit, I will say. LRM aims to identify promptly loans which develop credit weakness. Okay. Which develop credit weakness. It does not isolate potential problem areas. Does not. You want incorrect. It does not isolate potential problem areas. It is inefficient in providing top management with the information on credit information. It is inefficient. Okay, inefficient. So which one is incorrect you want? Aims to identify promptly. So will it identify this is true? But what do you want? You want false. Your question is false. Right? So it does not isolate. This is false. It is inefficient in providing top management. Inefficient. Again false. So B and C are false. You want false only. So the answer is B. Okay? Which of the following statement is not true for RTGS? Now this is simple. You need to answer this. Okay? This you should be able to answer. Give me the answer, everyone. Everyone, yes. Think of the answer. Read this first. Read this, everyone. Now give me the answer after reading. Yeah, the answer is here. In RTGS, the transactions are processed continuously on a transaction by transaction basis, T to T. So that's correct. That's why it's called as gross. Gross means what? T to T. The name itself means gross. Word means everything is grossed at the same transaction level. RTGS is primarily meant for large value transactions. Obviously, that is also true. True, right? The minimum amount of remitted through RTGS is 500 and maximum amount is 2 lakhs. RBI has waived the processing charges. This is true. So this is false. So this is the answer. Correct? This is the answer. Got it, everyone? The credit risk assessment exercise should be repeated. Credit risk. Biannually, annually, once in 3 years, none of the above. So credit risk assessment, it is repeated in how many, what is the period? Think over it. Yeah. Is it biannually, annually, once in 3 years? Actually, it's monitoring, regular monitoring. Okay. The rule says that it should be done annually. But you can do it before also. Okay, you can do it before also. Every year the credit risk assessment needs to be done for the large loans. Credit risk assessment is for the large loans. Kindly note. Okay. Got it, everyone? So now, before going, let me show you the new batches. The new batch is starting. Okay. Immediately join this batch. Immediately. Okay. Why? Because it is so important. It is starting from 24th. Okay. Go to Adda 24/7. Always go through the app. In the app, you will be getting 1% extra. always go through the app. See this, click on JIB and CIB, click on CIB. See this bonus batch starting when, what did I say, 24th Jan, starting on 24th. Limited seats, 6 a.m. to 9 6 a.m. means as per your bank timings. Ebooks, mocks, online live classes, best in class material, latest pattern, self-paced learning, device compatibility, everything you have. And what is the cost? Look at this. Never forget the code Y432. I gave you that code now on the slides. Y432. Click on apply. 80% discount you're getting. 80% plus 1% extra using the app. Download the app, purchase through the app. You'll be getting 1% extra. So 80% discount, 81% discount you're getting. Okay. As you can join the Mahapack also. In Mahapack, you'll be getting double validity. You buy for 6 months, you get it for 12 months. Mahapack double validity is for this 6 months package. You buy for 6, you get it for 12 months. It's so heavily loaded. Okay. So 78% off. Again same. Remember the code Y432. Never forget this code Y432. Now this 78 will change. Look at this. Now the 78 has changed to 80% plus 1% extra through the app. So 81%. So net what are you getting? 81% off plus double validity. So don't miss it. Join the batch immediately. 24th starting. You won't miss even a single lecture in that case. Okay. Chalo bye.